In chapter 2, we start getting into more journal entries and remembering those debits and credits. This is kind of a review of your adjusting entries, closing entries. We're going to get more into our financial statements soon. So let's remember how to do first our adjusting entries. So I'm going to go through this example. It's exercise 2.5 in your book. If you want to look there, they should have the same numbers. I think you even have the same numbers in your practice problem you have to do. So this should be simple for you, and we can walk through this together. So when we need to make our adjusting entries, typically they're going to give us some additional information to work with. They give us these 5 things. These are your 5 adjusting entries that you need to do. We're going to take them one by one and show you that journal entry. The equipment depreciates at $250 per month. Now, remember, this is an entry showing you that it's closing on March 31st. So we're looking at 3 months. So you might want to kind of note that somewhere. It'll come in handy when we're looking at all of these different problems. So when we do the adjusting entry for depreciation, we're going to debit that depreciation expense. Again, this is for 3 months. It's $250 per month, so that equals $750. And then we're going to credit our accumulated depreciation. And this is on equipment. We'll just note that. And we will credit that for the $750 as well. In number 2, it says that 1/3 of the unearned rent has been recognized. So we'll have to come back up here, look for that unearned rent account, which is right here. We're going to take that $9,300. And since 1/3 has been recognized, we'll divide that by 3, which should equal $3,100. When we recognize our rent, we're going to credit that liability to decrease it, credit the unearned rent revenue, for that $3,100. And we're going to credit our rent revenue for $3,100. And then we're going to look at number 3. It says interest of $500 is accrued on the notes payable. So we have to show that accrual with our interest expense. And it's just the $500 that has been accrued, and we'll have to pay that later, so we're going to credit our interest payable for $500. Looking at number 4, we're going to have to do a little bit more math here. It says supplies on hand equal $850. Remember, that's how much we have left. So we have to start with the amount that we had at the beginning, which is $2,800. That's how much we had to start with. We have $850 left, which means what we used, if I do my math right, should be $1,950. So this is what we had. This is what was left, and that equals what was used. So then I'll come down here, make my journal entry to show we no longer have those supplies available. That means we would debit our supplies expense for the amount that was used, which is $1,950, and we'll credit our supplies. And finally, the last one, it says insurance expires at a rate of $300. Remember, this is for 3 months, so we're looking at $900. And we're going to recognize the insurance expense. And then credit our prepaid insurance. We've already paid for this. We've just used some of it up. We're going to credit that asset account for that $900. So hopefully that gives you a good refresher on adjusting journal entries. Now I also wanted to look at another one that relates to the closing entries. Give you a quick refresher on that as well. Remember, there's always those 5-minute videos. If you need a little bit more guidance or like some more lecture type on some of these topics, now is a great time to go there and try those out. So let's look at these closing entries. Remember, when we're closing our entries, we're going to close them in order. I like to use our EID, revenue, expenses, income summary, and dividends. So let's look at some of the amounts they gave us and prepare those for closing entries. The first one, we're looking at revenues. Now this is just the revenue right here. So we're going to debit that sales revenue because it's normally a credit. And we close our revenue to income summary. Next, step 2, that was step 1. Step 2 is to close our expenses. All of these expenses have normal debit balances, so we want to go find all of our expenses and close them with a credit. This is going to close to income summary, so we debit that income summary. And we're going to find each and every expense and close it. And to make sure that we get everything, we're going to start with our cost of goods sold. Remember, it doesn't have to have the word expense. We're going to credit that for $208,000. We're going to look for, I'm going to first kind of go in order of how it's going to show up on our income statement, just to kind of get in the habit of that. So I'm going to then credit our sales returns and allowances. And that is $13,000. Don't forget the sales discounts. Which is $8,000. I'm going to start crossing these off so they're easier to find. And now we can go ahead and just debit each of our expenses. So we have our salaries and wage expense, and that was $6,100 or $61,000. We have our delivery expense, which is $7,000. Insurance expense, which is $12,000. And finally our rent expense, which is $20,000. Then what you're going to do is go through and just add up each of these totals. So I'm going to add all of this up here, and that's the amount that will go to your income summary. And if I did my math right, it's $329. And finally, because as you can see, I've crossed out everything, we have no dividends. So our third step will be our final step here, and that's to close out this income summary account, which is also a temporary account. So to close out our income summary, we have to figure out if we have a debit or credit. Here's my income summary account. In the T account form, I first had a credit of $350,000. I can't even read my own writing. Sorry about that. Then I have a debit of $329,000. In order to get this to go away, I want to make these even. So I know I need to add $21,000, which would give me a total balance of 0. So I need a debit to income summary for $21,000, and I'm going to credit the retained earnings. That's where our net income flows to on our financial statements, and therefore this shows that entry to show that. So hopefully that was a good review on the closing entries. Now once again, I want to show you how these longer problems especially will translate into some shorter problems on an exam. So this first one's talking about the adjusting entries, and here I picked one that wasn't really as clear. So they want to know when an adjusting entry would not, make sure you look out for those bolded or highlighted words like not or except, would not include what? So we know from reviewing that adjusting entries always include one income statement account and one balance sheet account. And we can look back up here to our adjusting entries and notice, for example, this expense is our income statement account, prepaid is our balance sheet account. So we always make sure we have one of each. So if I come back down here, that means that there's no way I could have a debit to an expense account and a credit to a revenue account, because I need to make sure each one has an income statement account and a balance sheet account. I mean, you can go through the other ones too and notice that they're all one income statement account and one balance sheet account. All right, let's look at one more. This is talking about these nominal or temporary accounts that we close during that closing process. So they want to know which ones do we close. So we can come back up to our closing process, and we know we close revenues, expenses, income summary, and dividends. So I can look through these and know that I'm going to close an expense account, so that must be a temporary account. Always go through and double check. The retained earnings stays open. Inventory is an asset account that stays open. And unearned service revenue, that's actually a liability and will also stay open. Hopefully this gets you started. Please let me know if you've got questions on any of this.